Welcome to the comprehensive video module on mergers and acquisitions insurance.
In the year 2018, the Indian telecom segment saw a massive shift in its landscape as two of its giants, Vodafone India and Idea Cellular, joined hands and merged their organizations to become Vodafone Idea Limited. This move was welcomed by the markets as a whole and at the same time gave rise to a lot of questions in the minds of customers and shareholders of these companies. Questions such as: who owns how much stake in the new entity? What effects will this deal have on existing and future customers? What happens in case of disputes arising out of this deal, if any, in the future? This video is designed to help you understand these aspects in a simplistic yet comprehensive manner. The examples used here are only for demonstrative purposes and not real-life examples. As far as consolidation of two or more companies is concerned, there are mainly two ways this can be done. In a merger, two companies join hands and form a new entity under a new name, whereas in an acquisition, a company entirely buys out another company. In the example we discussed above, both parties undertook a merger deal. To safeguard the interests of both parties, a bucket of insurance products is designed by insurers, which is collectively called mergers and acquisition, or M&A insurance. There are a lot of known and unknown risks involved in an M&A deal. These products help the buyers and sellers reduce the impacts of such risks. The insurer is a credible party. Hence, buyers and sellers don't need to rely on each other for funding the risks that may arise from the deal. Also, the costs for the insurance policies are typically shared by both parties. Furthermore, given the comprehensive coverage provided by the insurance policies, there is no need to ask for specific protections against every risk. As far as the several types of these insurance products are concerned, there are three main types of M&A insurance, viz., representations and warranties, R&W insurance, tax liability insurance, and discontinued product liability insurance. We can now understand each of these types with the help of our initial example of the Vodafone Idea merger. Let's say either Vodafone or Idea had mentioned in the deal document that the company closed a particular quarter in profit, or that currently the company is not facing any lawsuits. These statements are called representations and warranties, which also act as negotiated allocation of risks, wherein the buyer and seller make it clear as to which party will be responsible for which of the future risks that may arise from the closing of the deal. If later the other party finds these statements to be false, they can mitigate the risk by using the R&W insurance policy bought before the deal was finalized. Secondly, the tax liability is the total amount of tax that was to be paid by either or both Vodafone and Idea before the deal. This includes all local, state, central, and foreign taxes. If either party is failed to make any such payments in full and on time, the government can issue a notice for recovery at a later date. At this point, the tax liability insurance can step in and fund any such tax payment. Let's assume there were some types of SIM cards and connection offers Vodafone was running before the merger, which they stopped offering before the finalization of the merger deal. After the merger is finalized, if a customer raises a dispute or brings a lawsuit regarding any such discontinued SIM or connection, the discontinued product's liability insurance can be used to fund the settlement of such a customer grievance. These are some of the ways M&A Insurance helps the buyers and sellers involved in a merger deal.